Welcome to this audio summary of Debt Man Walking, a 10-step investment and gearing guide for Generation X by Bruce Brammall. If you were born in the 1960s or 1970s, you're part of Generation X, and this book is written specifically for you. You're likely in your prime earning years, juggling career, family, and financial responsibilities, and wondering how to turn all of that hard work into real, lasting wealth. In this series, we'll break down Brammall's key ideas on using growth assets, smart debt, and simple rules of money to design the financial future you actually want. Across these episodes, you'll learn why your home is more than just a place to live, how to tell dumb debt from great debt, how to think about risk, and how to use time, compounding, and diversification to your advantage. We'll also cover the role of insurance, the power of professional advice, and practical strategies that can help you move from just getting by to building long-term security. Before we dive in, a quick favor. If you find this content valuable, please take a moment to follow or subscribe to the show so you don't miss upcoming episodes. And if you're listening on a platform that allows ratings or reviews, a quick rating or short review really helps more people like you discover the summary. If you know a friend, colleague, or a family member in Gen X who's serious about taking control of their money, share this audio with them as well. It might be the nudge they need to finally get started. Now, let's begin with the key concepts behind Debt Man Walking and see how Generation X can turn time, smart debt, and growth assets into a stronger financial future. Introduction. Setting the stage. Brammall distances his approach from the typical get-rich-quick books. This is not a magic formula, not an overnight success scheme, and not aimed at those just starting out in life or those about to retire. He makes it clear that Debt Man Walking is written for Generation X, those born roughly in the 1960s and 1970s. Most Gen Zers in the first decade or two of the 21st century have finished their education, held one or more jobs, developed a steady income, learned basic money management, formed a vague picture of retirement, but often without a clear plan to get there. The good news is that Gen X, as a group, is well positioned to plan and invest for the long term. What they need are the right incentives and a practical roadmap. Brammall warns that neither pure fear nor pure greed should drive financial decisions. Instead, he suggests using a balanced mix of both as motivation to save for a house deposit, buy a holiday home, fund children's education, and still live comfortably in retirement, where work becomes a choice rather than a necessity. He then outlines 5 fundamental concepts that underpin everything in the book. 1. Delayed gratification. Investing means giving up some enjoyment today for greater rewards tomorrow, choosing to invest that $1,000 instead of spending it now. 2. Risk versus return. Higher potential returns usually come with higher risks, especially in the short term. 3. Compounding growth. When returns are reinvested, they grow on themselves. The earlier you start and the more consistently you add, the more powerful compounding becomes. 4. Diversification. 5. The power of leverage. Don't put all your eggs in one basket. Applies strongly to investing. If one investment struggles, others may do well and balance the overall result. Leverage means using other people's money, borrowing, to invest. In Brammall's Australian terminology, this is called gearing. He stresses that gearing is generally unsuitable for very young investors and those close to retirement, but can be extremely powerful for Gen X when used carefully with growth assets. Brammall then offers a simple way to think about how much money is needed for a never-ending income stream in retirement. Start with the annual income you want in retirement. For example, your current after-tax family income. Then divide that by your assumed long-term investment return minus expected inflation. In his example, he assumes a 9% long-term return and 3% inflation. So 100,000 divided by 6% results in a required lump sum of about 1,666,667. He ends the introduction with an X flip, a short mental shift for Gen X. Learn to say yes to starting. The path to financial security is rarely a single leap, like winning the lottery, but a mapped journey. Progress begins when Gen Zers commit to taking the first step. Step 1. Write your own ticket. In Step 1, Brammall urges Gen Zers to recognize where they are in life and to take responsibility for their financial destination. Most have some career stability, a consistent income, a long runway to retirement. They are perfectly placed to decide what they want from life, whether that is travel, early retirement, a larger home, or time freedom, and then to build a plan to write their own ticket to that future. He re-emphasizes the three big variables that determine how much money people will need. 1. Long-term returns from their investments. 2. The income they want in retirement. 3. Inflation, which erodes the purchasing power of money over time. By understanding these levers, Gen X can realistically calculate what they need and plan accordingly. The Step 1X flip is about commitment. Stop waiting for a perfect moment and start the journey. Saying yes to a plan, even a small, imperfect one, is more powerful than staying frozen at the starting line. Step 2. Money's simple rules. Next, Brammall introduces basic investment principles that apply across countries and markets. He highlights that some rules are universal, while others are specific to certain tax systems or pension schemes. For his Australian audience, he explains unique features such as capital gains tax rules, negative gearing, which acts as a tax incentive when investment costs exceed income, franking credits, which help avoid double taxation on dividends, depreciation rules on assets, superannuation, or super, Australia's retirement savings system, where contributions are taxed at a low rate. The funds grow with concessional tax and can be accessed in retirement at favorable tax rates. He then introduces an 8-question risk profile test, which sorts investors into one of 6 categories based on how much investment risk they can tolerate, both financially and emotionally. Those 6 profiles are 1. Conservative, strongly risk-averse, focused entirely on preserving capital, suited to 100% income investments. 2. Cautious, willing to take very small risks, still focused on preserving capital, typically 80% income and 20% growth. 3. Judicious, open to small, short-term risks, roughly 60% income and 40% growth. 4. Prudent, uncomfortable with very high risk, but willing to accept some volatility, around 40% income and 60% growth. 5. Assertive, understand market ups and downs, and seek strong long-term growth without being reckless, about 20% income and 80% growth. 6. Aggressive, aim for maximum long-term returns, understand market behavior, and often seek to reduce taxable income, 100% growth. Brammall cautions that this profile should not rigidly dictate every single decision. Some investments, like superannuation or government pension schemes, may warrant a slightly higher or lower risk stance. Couples should each complete the profile, compare their results, and then decide how to proceed together if their risk appetites differ. He reminds readers that they must balance risk and sleep. If investments cause constant anxiety, they're likely taking on too much risk. At the same time, an excessive fear of loss must not be used as a reason to avoid investing altogether. The big win to avoid is gambling, lottery tickets, and hot stock tips dressed up as investments. The Step 2X Flip challenge is a common saying, save to invest. Brammall suggests that Gen X, in the right circumstances, can flip this idea and invest to save, using investments, including carefully managed gearing, as a powerful engine to build savings and wealth. Step 3. Risky business. Step 3 focuses on risk. Brammall argues that the greatest financial risk for Gen X is not investing at all and simply hoping that government pensions or insurance payouts will provide a comfortable retirement. He notes that, psychologically, people feel losses about twice as strongly as gains. This fear pushes many to avoid investing, even when the odds are in their favor over the long term. Brammall's response is clear. Calculated risks, diversified and spread over time, are essential for meaningful returns. He returns to the concept of risk profiling and emphasizes that each investor's plan should match their real ability to cope with losses, both with their wallets and their emotions. He stresses that investing is a long-term game. Short-term losses are inevitable. The key is to stay the course and not panic. Brammall also introduces different ways to access growth assets. With shares, for example, investors can buy shares directly in individual companies. Use listed investment companies, which invest in other companies on investors' behalf. Choose managed funds that invest in cash, fixed interest, shares, and property. Use index funds or exchange-traded funds, which simply track an index rather than being actively managed. For property, investors can buy residential or commercial investment properties directly. Use listed property trusts, such as REITs. Invest via property-focused managed funds. Use unlisted or direct property funds, where investors own units in a fund that purchases and manages large properties. The Step 3x Flip tells Gen Zers to stop focusing solely on today's bills and start thinking about tomorrow's needs. This does not mean ignoring current obligations, but it does mean starting to invest now, even in small amounts. Time is on Gen X's side, but only if they use it. Step 4. Gen X's investment edge. In Step 4, Brammall explains why Gen X has a unique advantage: time combined with experience. They have been in the workforce long enough to build skills and a reasonably stable income, yet are still decades away from retirement. He divides investments into 3 broad types. 1. Income assets, where the main benefit is the income they pay out, such as interest, rent, or the distributions. 2. Growth assets, where the primary benefit is an increase in the value of the asset itself, such as rising share prices or property values. 3. Mixed assets, which offer a combination of income and growth. For Gen X, growth assets are especially powerful because they have enough time to ride out volatility and benefit from long-term growth. Shares and property are the classic growth assets. Brammall does not pick a winner in the shares versus property debate. Instead, he points out that both have strengths and weaknesses, cycles of boom and bust, and a history of reasonable performance over long periods. His advice: hold a mix of both and diversify within each category. The X-Flip for Step 4 reinforces the logic of diversification. Buying one investment property or a small cluster of similar shares does not give enough protection from bad luck or market downturns. Gen X should aim to build a broad portfolio of growth assets to smooth their journey over time. Step 5. Home. Investment Central. Step 5 is about the family home. Brammall argues that, in most cases, Gen Zers are better off buying rather than renting their primary residence if their goal is long-term wealth creation. He describes a home as a lifestyle choice, a place to live, and a central tool in wealth creation. While a home is not just an investment, its growing value and accumulated equity can be used as a powerful financial resource. As equity builds, it can be accessed through loans or lines of credit and then used to fund other growth asset investments. The Step 5x Flip is about mortgage strategy. Once Gen Zers have been paying their mortgage for several years, and their income has typically risen, they reach a point of breathing room. With this extra cash, they have several choices, including increasing lifestyle spending, paying down short-term debts, trading up to a more expensive home, accelerating mortgage repayments, using the surplus to start a separate investment program, or mixing several of these options. Because of their age and earning trajectory, Gen X is in a prime position to choose a smart mix, with a strong emphasis on starting an investment program sooner rather than later. A few rewards are fine, but the real engine of wealth is early and consistent investment. Step 6. Investing, the debt mantra. This step is the heart of the book. Brammall explains how Gen X investors can use gearing, borrowing to invest, in a conservative, disciplined way to build wealth with growth assets. First, he defines good and bad debt with his dog framework. 1. Dumb debt, used for things that fall in value and whose interest is not tax-deductible, such as consumer goods, cars, and holidays. 2. Okay debt, used for things that rise in value but are not tax-deductible, like home loans or renovations on a primary residence. 3. Great debt, used to buy assets that grow in value and whose interest is tax-deductible. This is the type of debt at the core of his strategy. Great debt, when applied to quality growth asset investments, is the key to wealth creation for Gen X. He stresses that gearing adds risk and therefore requires two essentials: a reliable income, a time horizon of at least 7 to 10 years. Gearing is not for short-term plays. It must be part of a long-term, carefully structured plan. Brammall describes 3 types of gearing. 1. Positive gearing, with investments income, such as rent and dividends, exceeds the cost of borrowing. This suits lower-income investors or those seeking additional passive income. 2. Negative gearing, where the investment costs exceed its income, creating a tax-deductible loss. This can make sense for higher-income earners willing to trade short-term cash flow loss for long-term growth and tax benefits. 3. Neutral gearing, where investment income roughly matches borrowing costs. This suits those who do not need extra income today, but want more assets for future growth. Gen Zers using gearing must borrow conservatively, increase their debt gradually, avoid starting with too much debt at once. Entrepreneurial Gen Zers, for example, may be better off borrowing to start or grow a business rather than draining their own savings entirely. The X-Flip for Step 6 introduces the idea of recycling or going green with debt, replacing non-deductible debt with deductible investment debt where appropriate. This is a more advanced strategy that often requires guidance from a tax expert and a financial planner. Step 7. Axe, Santa, and other little helpers. In Step 7, Brammall emphasizes the value of professional advice. He recalls finding a specialist tax advisor early in his career and learning that tax planning is important but does not have to be complex. That paying for expert advice can more than pay for itself. He encourages Gen X investors to work with tax specialists, financial planners, lawyers, bankers and mortgage brokers, real estate agents, insurance brokers, accountants. He also warns that investors must distinguish between true advisors and salespeople pushing products. For Gen Zers in relationships or marriages, investing as a partnership can create tax advantages. For example, they may spread income more evenly between partners, shift assets deliberately from one partner to the other, hold positively geared investments in the name of the lower-income partner, hold negatively geared investments in the name of the higher-income partner. He notes that tax-related decisions should be planned to take advantage of deadlines and incentives, including prepaying interest, using capital-protected products, or maximizing depreciation and other deductions. The Step 7X flip is simple. Stop trying to do everything yourself. Gen Zers should focus on excelling in their own careers to increase income. Learn enough about money to avoid big mistakes. Lean on qualified professionals for detailed strategy and tax optimization. Lack of knowledge is not an excuse to procrastinate, and overconfidence is not a reason to ignore expert help. Step 8. Blockbuster budgeting. Step 8 is about turning big dreams into numbers and plans. Brammall reminds readers that money is only a means to an end. Education, travel, charitable work, debt-free living, and so on. He uses a practical example. A hypothetical Gen X investor who wants $500,000 in 12 years. Adjusting for inflation, he calculates that the real target should be around $713,000 in future dollars to match that purchasing power. Starting from nothing, he outlines 5 strategies, each with a different risk level. 1. Strategy 1. Save. Deposit roughly $3,500 a month into a bank account earning about 6%. This is low risk, but growth is slow. 2. Strategy 2. Balanced approach. Invest about $3,000 a month in a diversified managed fund, spread across property, shares, cash, and fixed interest. This carries moderate risk and might average around 8.5% over 12 years. 3. Strategy 3. Going for growth. Invest roughly $2,696 a month, all into growth assets like shares and property, with no borrowing. Volatility will be higher, but the long-term return might average about 10.5%. 4. Strategy 4. One small step for Gen X. Use gearing. Invest about $2,232 a month of your own money and borrow a matching amount via a line of credit or margin loan. Here, Brammall assumes borrowing costs at 8% with growth assets earning 10.5%. 5. Strategy 5. Extreme debt investing. Borrow the entire amount to invest, around $263,000. Pay interest only of about $1,700 a month for 12 years, and then repay the principal at the end. Again, borrowing costs are assumed at 8% and growth at 10.5%. He then compares how each strategy performs over 12 years if the investor puts in a fixed $2,500 a month or $30,000 a year. The approximate outcomes before inflation are around $506,098 for strategy 1, around $586,477 for strategy 2, around $661,132 for strategy 3, around $798,566 for strategy 4, around $1,017,135 for strategy 5. The message is clear. Higher risk gearing strategies can produce significantly higher returns, but they come with greater volatility and require discipline and staying power. The step 8x flip is expressed as calculate the weight, don't procrastinate. Gen Zers should not delay getting started. Their main advantage is time, and the way to use it is to begin at whatever scale they can manage as soon as possible. Step 9. Cover your assets. In Step 9, Brammall pushes readers out of their comfort zones by confronting the reality of risk in life, not just in markets. He points out that most people insure their possessions, their cars, their houses, their belongings, but fail to insure their most valuable asset, their ability to earn income. Accidents, illness, or death can quickly transform financial stability into crisis. For Gen X, especially those using debt to invest, insurance is not optional. Brammall recommends considering life insurance, disability insurance, health and trauma insurance, income protection insurance. He offers rough guidelines. For couples without children, life insurance might need to be 8 to 10 times annual salary for each breadwinner. With children, it might need to rise to 12 or 13 times. Investors should maintain cover until they have sufficient assets that their family would not be left in financial ruin if something happened. The Step 9x flip asks Gen Zers to stop seeing life insurance as a grudge purchase. The comparison is stark. What is more valuable, a $25,000 car, or the $2 to $3 million you may earn between now and age 65? Conclusion. Just do it. In closing, Brammall notes that there is no formal Step 11. The final step is action. Gen Zers must take control of their finances and start investing now. The ideal path, according to the book, is to own a home they can afford, protect their income and family with appropriate insurance, understand and apply basic investment principles, use diversification and growth assets, and, where appropriate, harness geared debt carefully and conservatively over time. The book's final message is simple but powerful. Gen X has the time, income, and tools to build the future it wants. The missing ingredient is action.